All right. We are here today with Bobby Lowe, who is the private banker for JP Morgan. Man, thanks so much for being part of our class.
Thank you. Thank you for having me, Brian.
So, how did you get into this role? Like, did you study finance? Where'd you go to college? How did that happen?
Sure. Well, it was a fairly circuitous route to get to where I am today. I grew up in Houston, attended the University of Texas and studied accounting of all things, and started my career as a CPA with Deloitte and Touche in the Houston office. Then had the opportunity to go overseas and spend some time in Moscow, Russia, and came back to the United States in New York, and then finally to Zurich, Switzerland. In between wealth management and accounting, I spent a number of years in investment banking, but have been in wealth management now for about 17 years. I'm at JP Morgan in the private bank. Prior to JP Morgan, I was with Merrill Lynch. And the way I got the opportunity to work with JP Morgan was actually through a personal relationship that I had with a gentleman that worked at JP Morgan that I had made years prior. There was an opening in the JP Morgan Fort Worth office. Right. He introduced me to the market manager who interviewed me, and that's how I got the opportunity. Okay, and so
so within your job, I mean, like, that's interesting because, like, an accountant to go into a private banker. So, what do you do on a daily basis within your job role now?
Sure. So I have I'm the primary point of contact for approximately 40 families that I serve. I have a team of professionals that work closely with me. I have a dedicated investor that's on my team. We have an attorney, a tax and estate attorney. We have a trust group, a customer service banking team, a lending team. So we lend to the clients, and essentially we're the financial advisors for the firm's most wealthy clients. So I work with families that have at least 25 million of investable assets as defined, cash, stocks, bonds, private investments with JP Morgan.
So one of these customers comes to JP Morgan. Are you the contact? Are you the kind of the glue between all of these people, like the investor and the lawyers and all those people? Are you always in every meeting with these people, or do you say, let me refer you to the investor, he's over there? How does that work?
Yeah, great question. And I think that is probably one of the biggest differentiators between how JP Morgan in general, and I in particular, serve the clients that we serve as compared to most of our competitors. And so I'm in every meeting. It's my responsibility to know about everything that's related to the client, what's going on with their legal situation, their estate planning, their taxes, their investments, their financial plan, their goals-based plan. So anything and everything that touches them financially, and oftentimes things that don't affect them financially, they would come to me first. Yeah. And then I would maybe give them initial advice, but then bring in a partner on an as needed basis to assist in any ways that I want. Sometimes I even, in fact, it's oftentimes I'll have to go outside of JP Morgan, have relationships with other professionals outside of our firm that I would bring into the relationship to help advise the client.
So what are these people like? I mean, are they just like, money? Are they just, I mean, is it just, are they pulling up in their Lambo and getting out with their fur coat and their, I mean, what is this customer like?
So no to everything that you said. So I don't work with clients like that. I primarily, the majority of the clients I serve are individuals or partners who created a private business, and typically I'm introduced to them years before what we would call a liquidity event. And essentially what I mean by that is they typically sell all or part of their business, and I advise them leading up to the sale of their business, and then what to do once the business is sold. I also have probably 20% of my clients are corporate executives of large public companies. So companies that are actually listed on either the New York or NASDAQ stock exchange. So those are the typical clients that I serve. Most of them, you probably would have no idea if you met them that they're worth as much as they are. I mean, they live in nice houses and drive nice cars, but they typically are not very flashy in the way that you would have
Why
described,
not?
Brian.
Why not? I mean, you're there. I mean, you've hit it big. You've sold your business. I mean, if not, then when, like, why don't they flash a little more?
Yeah. I think, and again, there's always exceptions to what I'm going to share, but the clients that I tend to work with have not earned their money typically quickly. They've had to work a long time and work very hard to earn their money.
No.
In fact, I can't think of any client that I work with who made their money in a short period of time. Typically, they've had to struggle for years to build a business or to work hard to become an executive at a large corporation. And so when they get to a point when they have what we consider significant wealth, it's usually after, in some cases, 10 years or decades before they've earned it. And so for them, there's a level of appreciation and responsibility for the wealth, both for themselves and for their families. And so because of the effort that they've had to put in to earn the wealth, and I think the humility that they have, realizing that there were hundreds of people or dozens or hundreds of people, even people they knew that were smart, maybe even smarter than them, or even worked harder than them, that did not achieve the level of wealth that they did, in some cases failed terribly. There's a humility, with that, and a responsibility for the wealth that they generated. So they feel that it would be, in many ways, it would be anathema to them to be showy or to draw attention to themselves as if somehow, they were the main reason that they generated the wealth, if that makes sense.
It's got to be tough though. When I in college, I worked as an intern for the Chargers, and I see these athletes come in and they would just get massive signing bonuses, and people would just come out of the woodworks, knowing, I mean, their salary is published, right? But your customers, people probably know, hey, this guy sold his business. There's probably at least with the Chargers, it just seemed like there were a lot of people all of a sudden around these guys, right? I mean, as an advisor to them, like what kind of advice do you give them with their wealth? Like, where do they put their money?
Yeah. So great question. And that is true, especially for the clients I work with that are executives at public companies, because all of their financial information, their salaries, their bonuses, is public information that anybody can look up. Right. And so they're getting, constantly brushed. Private business owners, less so. Some of them can completely fly under the radar, but still people know about them, and it's common. For me, trust is typically the most important thing, and that's hard to to develop with an individual. Usually, when I'm first getting introduced to them, there's a sense of trying to get to know them, what's important for them. I think, most of the people that I work with are very successful, and they tend to be very good at judging people and delegating. And so I think they, when we're having a conversation initially, as you said, they're getting calls from a lot of people who tend to be, most of which are tending to be people that are just selling maybe products and not giving advice, and they're not asking questions, open-ended questions to understand what's important for the client. And I think by doing that, it helps me to really put myself on their side of the table, so they see me as a trusted advisor as opposed to a salesman that's trying to sell product to them. And so that's, I don't know if that answers your question, but that's kind of
Yeah.
how I.
No, and I mean, and I think by the time this airs, I think we're going to be watching the 30 for 30 broke as well, where these trusted advisors were giving professional athletes, advice, and they were, scamming them of money. So I would think these guys coming in to meet with you would probably come in with their radar up pretty, can I trust this guy? Like, how do you like, I mean, you obviously do you take them to a Ranger game and try to get to know them? Or do you or is it just like, hey, let's go out for dinner and let's chat? I mean, how do you build the rapport so that they realize this guy's not a scam artist? He's here to, I mean, obviously you work for a very reputable firm, right? So it's not like you're just some corner office somewhere that nobody knows who you are, but how do you get their trust?
Yeah, great question. So as you mentioned, I mean, there's definitely a benefit working for JP Morgan. We're the largest bank in the world. We have one, probably the top, if not one of the top wealth management groups in the US. And so there's definitely a level of credibility that goes with us with that. Having said that, I think it's all of the above. I typically, when I'm meeting with a client, I know because I've worked with so many clients and I've transitioned so many closely held business owners and corporate executives kind of through the process. I have experience in what they're going through. And so when I talk to them, they understand pretty quickly in the conversation that I'm somebody that understands where they're coming from, where they're at, how they're thinking, what's important for them. And so but I still ask questions to try to understand uniquely to them what's important. And then as I'm taking them through the process of what we consider the wealth management process or the goals-based process, identifying what their goals are, and then helping them to build a plan to achieve those goals, they tend to think, okay, this is what I want. I'm the whole way through the process, sometimes directly, sometimes implied in what I share. I'm telling them this is your wealth.
Right.
You can do whatever you want with your wealth. You may disagree with the advice that I give,
Right.
and that's fine. My job is to tell you, what I think, you should do based on what your goals are. Having said that, if you disagree and decide to do something different, that's okay. I mean, there are a handful of things that I would consider, a non-negotiable, where I would be fairly direct with them, and sometimes I have to be that way with clients. But for the majority of the time, as long as they're able to achieve their goals with taking a reasonable amount of risk, then I'm comfortable with that, and they tend to be comfortable with that as well.
So what are the common investment strategies do they have? I mean, are they going in on Ethereum? Are they all about Dogecoin, or what? I mean, are they all about ETFs? What are they? Are they into index funds? Do they buy real estate as passive income? What is their common denominator for investments?
Yeah. So we take, you've heard me mention this a couple of times already, but because we take what we call it a goals-based framework, oftentimes in industry is called a financial planning framework. But essentially what that means is, we start with, when we're talking to the client, what are your goals? What do you want to achieve in life, personally, professionally? What do you want your wealth to accomplish? Do you want to transition a large amount of wealth to your children or grandchildren? Are you philanthropically inclined? Meaning, do you want to give? Do you want to give to your church? Do you want to give to your synagogue? Do you want to give to your alma mater, whatever it might be? And so it's identifying what the client's goals are. It's identifying, what their lifestyle spending is. And that could be in the hundreds of thousands. It could be in the millions of dollars. And then understanding if their lifestyle spend and their goals are achievable given the level of wealth that they have. And so that's always the starting. We never start with, you should invest in this or that. That is, I would consider that, frankly, foolish. As if somehow the wealth, it's like you've bought a nice car, but you don't have a map and you have no idea where you're going. You're never going to get to, you're in a nice car, but you're going the wrong way, and you're never going to get to where you need to be. So you have to start with a plan, and then you work your way back from the plan. Typically our clients, the first mandate they give us is, number one, I've worked really hard for a long period of time to earn this wealth. Don't lose my money. And obviously we can't guarantee they'll never lose money or it will never be down. But we take that very seriously. And so we're always looking to take the minimal amount of risk to achieve their goals in terms of what we're investing in. And then the second part of the mandate is typically earn me a reasonable return in order to achieve my goals. And so again, that's the starting point. And then specific to what they're invested in, I have no clients that invest in cryptocurrency and Ethereum or things like that.
None of them just too risky.
Well, I think it's, again, and I'm not anti cryptocurrency, and it's not something that we would say, our clients, as a firm, generally as a rule of thumb, if that's something our clients are interested in, we don't have the option of offering that to our clients. There are other ways that they could invest in crypto or other types of investments. We would typically suggest they don't invest more than, call it 5% of their liquid net worth in something like that. Again, just primarily related to the volatility of cryptocurrency. So, but most of my clients are invested in primarily, stock bond portfolio. And then within that, there's a level of diversification. And then for our wealthier clients, they're investing in private equity, private credit, and things of that nature. So that would be kind of a typical client portfolio that I would work with.
How do they feel about debt? Do they keep mortgages on their houses? Do they pay them off? Do they buy cars with cash? How do they handle those kinds of things?
Yeah, great question. So it's interesting. Almost all the clients that I work with, when I first meet them, are extremely debt averse and very proud of the fact that they've paid off all their debt. They have no debt. When I typically,
so they aren't trying to leverage debt all the time.
So that they are not. Now, having said that, when there's, I would, and this is, I have to be careful how I phrase this, because this is the less than 1% of Americans. I'd say for 99.9% of Americans being debt-free, there's no question that that's the way to go. And if you're not there, aspiring to get there very quickly, will make a tremendously positive impact on your personal financial situation. Having said that, for the very wealthy clients, typically what I'm encouraging them to do is to use debt, what I would consider in a smart way. And so there's different ways you can do it. I can give you a couple of examples. One, almost all of my clients have what's called a marketable secured credit line, which is essentially a credit line which is collateralized by their investment portfolio. It's free to set up. We don't pull their credit, and the rate they pay is very reasonable. So the only time they would ever pay anything is if they drew on the line. And typically the clients I work with will draw on the line for a myriad of reasons. They may have a liquidity need. And so that it's typically a bridge type situation. It's never permanent debt. They need the money for a brief period of time. And so as not to have to sell maybe their securities or sell other assets, which will trigger taxes, they will draw on the line to meet the need and then eventually pay the line down. Another area, sometimes our clients, and I'm doing this actually pretty often recently, the clients I work with don't need to have mortgages on their house. They can pay cash for multi-million-dollar houses.
Wow.
We typically, there was a change in the law a couple of years ago, which limited the deductibility of interest on a mortgage to a $750,000, which for the vast majority of people in the United States is sufficient. Most people have mortgages under $750,000. The clients I work with don't have mortgages, or they wouldn't have mortgages that low. And so it's not attractive for them to have a purchase mortgage north of that, because they would not be able to deduct the interest. But what we're seeing, and what an example of how we would advise some of our clients on what we call tax aware borrowing. So a client may purchase a home for cash, and then they do what's called a cash out refinance mortgage. So they put the mortgage on after they've purchased the home. As long as the proceeds from the mortgage are invested, so not used to pay off other debt. If you invested, is deemed investment interest,
Yeah.
which is limited to 750,000 and can be fully deductible for tax purposes. So that's an example of where you could use debt in a wise way. Again, not applicable at all for 99.9% of Americans, but for my clients, it makes a lot of
I mean,
sense.
this just isn't fair. This is not a fair game because, like, you're telling me they can get a credit line, and which, by the way, my wife and I have a credit line too with First Financial through our rental properties and our business and all that, and we can get 4% or whatever it is. But if I'm the average consumer and I need a cash advance, and I go down to the bank with my credit card and I get my cash advance that way, and if I can't get a home loan or I can't get a loan or whatever, I go get cash advance. It's like 25% interest or whatever, and cash advance fees. I mean, Joe average public doesn't have a team, advising them, right? They are trying to navigate this world in a system where it feels like they get 3 outs per inning and your clients get 12 outs per inning, right? It's like, it's just not fair. What do you tell to like my students who are saying, well, gosh, I want to be on that side of the equation. I want to be on the right side of inflation. I want to be on the right side of investing. What advice would you give my students?
So the advice I would give, putting the fair or unfair comment aside for a second, and I would say first of all, I cannot think of any clients I work with. It's not to suggest there aren't. I mean, obviously there are people, wealthy individuals, and probably most of the wealthy individuals that your students are going to read about in the news are going to be individuals who maybe inherited wealth or came from wealthy families. I don't work with those clients. I really don't have very many of those clients. The clients that I work with are typically first generation wealth.
Right.
And I would say the vast majority of them came from very meager means. In fact, they were probably grew up in families that had less resources than all of your students at Capel High School, and they just worked hard. They didn't go to, I don't have very many clients that went to Ivy League schools. I don't have very many, I have some clients that didn't even go to college, right? So I would say, the advice I would give your students is if that's important, for them, they feel that they would like to, maybe live that type of lifestyle. And that's a different conversation altogether in terms of, but, I would just throw out the window the whole fair, unfair. Most of the people I work with, like I said, they worked hard, they saved their money, they had great ideas, and they were humble, and they achieved success. And then once they got to the level of success, then they're given the opportunities of the things you described. So again, I would just say it's maybe not fair, or it wouldn't be fair to compare apples to apples with Joe consumer versus that individual. Not to suggest, look, there are definitely people who have come from tremendous wealth and they've had advantages. Those are just not the people I work with.
Interesting. So your son, David, and my son, Henry, they both play on the same baseball team. They both play catcher and third and pitch and do all that kind of stuff. When David goes off to college, or maybe now, and as he grows up, what financial advice will you give him?
Yeah. So, I would put it, I would say a couple things. Number one, and it's going to sound very simple, but very, very few people do it. And it would be, number one, live within your means, right? So if you try to avoid debt at all costs, and especially credit card debt. I abhor credit card debt, and my advice to anybody would be, if you have credit card debt, prioritize paying that off almost above everything. Even savings. Eliminate debt as quickly as possible, right? So that would be point one. Live within your means. I think point two would be we encourage our children to save, and typically we would say save at least 10%, as much as 20% We don't, as a family, I don't focus as much on what you save it in. I
Yeah.
think it would be fantastic to save it in, to start learning about the stock market and bond market. We do that to a degree with our, our kids are 10, 11 years old. Obviously, when you get to high school, I think you're in a position where, I mean, not to suggest a 10-year-old couldn't understand, but I think the principle of saving at a young age, and that could just be putting it in a savings account. If you're investing in the markets, it's fantastic. Eventually, when you get a job, being diligent about saving 10 to 20% of your income in a retirement plan, in a 401k, an IRA, or whatever that might be, the compounding of that, doing that for years and years and years, is tremendous, and will really put you in a strong situation financially. And then, as a family, personally for us, and honestly, I've actually seen this, not with all of my clients, but I'd say with the majority of my clients, is we impress upon them giving. For our family, it's, we encourage them to give 10%
Right.
of what they have. We as a family choose to give that to the church that we go to, but if they want to give that to philanthropy, I think having a giving heart and a savings heart really protects you from a lot of the financial deceptions that that people encounter.
Well, it sounds like simple advice. It's stuff we talk about every day in my class. So I appreciate you saying that as well. Thanks so much for being in our class. We really appreciate it.
Yeah. Thank you. Thank you.